Hello, I'm Bernard Hickey from interest.co.nz and welcome to another of our double shot interviews, and we're here today on the 7th floor of the Beehive with the Finance Minister, Bill English, who's campaigning to be re-elected. We thought we'd ask about the economy, the various policies going into the election campaign. Bill, thank you very much and welcome back to interest.co.nz.
Thanks, Bernard.
The idea of shifting the structure of the New Zealand economy was right at the core of what the government's been doing, shifting from a borrowing, spending, importing economy to one that's focused on exporting, producing, investing. How successful or not have you been at doing that? Because you use this great chart over the years showing the tradable sector versus the non-tradable sector, and actually the gap has continued to widen under National's government.
Yeah, the gap between tradables and non-tradables has been affected by the recession, but I think the signs of it moving the other way are there, bearing in mind these things take some time. So we've got, on the one hand, good terms of trade, probably the best have been 30, 40 years. In the initial stages, the people benefiting from that are dealing with their debt. If those terms of trade are maintained at something like that level, I suspect they'll come back a bit, then that's positive. A lower exchange rate would help a lot. On the other hand, you've got, as a measure of shift, the housing market's now been pretty flat for coming up 4 years. That's a less radical adjustment than, say, in the US, where it's driven by fear and financial collapse, whereas here it's more moderate, but going in the right direction. And of course, government's sharpening up its surplus trap, and that'll put a lot of pressure on the non-tradable sector.
But can we really change our economy with a currency at nearly 80 cents?
Well, we have to, because that's where it is. The markets can't decide. From week to week they decide we're a safe haven on 1 week, and the next week we're a little debt-ridden country that might be too risky. But it does seem to be in that 75, well, that 80 cent bracket, 78 to 80. That's the headwind, but we have to, all that means is the threshold's a bit higher for what you need to do to make progress.
But when you say we've stopped investing so much in housing, when you look at house prices, particularly central Auckland, they're up 16% from a year ago, and we still have 95% home lending out there. Have we really changed our ways there?
Well, of course, that'll be put to the test by the passage of time, but that I have to say that's only one bit of the market which is going up. The banks, if you want to measure whether it's changed, just talk to the banks. The banks are now quite clear that the model that they had for growth of more mortgages to mum and dad has pretty much come to an end. Credit growth is around zero. They now have to actually do a good job of lending money increasingly to business if they want to grow. So that's not a bad measure of the progress.
Yet the Treasury itself is forecasting a rise in our current account deficit over the next couple of years to 6 to 7% of GDP. Surely with record high commodity prices and a change in the structure of the economy, there's no way we should have a current account deficit that high.
Well, we certainly want to see a better result on the current account than that. There's a couple of things driving that. One will be Christchurch, and the way they account for that means that all the imports will come through the current account, or accounted for that way. And the other is that as the economy picks up, business investment is picking up. So the composition of the current account matters. If it is driven by more flat screen TVs for new homes, then the same 6% is worse than if it's driven by investment. But we're certainly hoping for better performance than that.
But isn't it being driven by government borrowing and an inflow of capital as the government essentially has a dis-savings rate? Yeah,
that has been a problem, and that's partly deliberate choice through the recession for the government to keep borrowing to support the economy. But now we've put in place in the last budget a pretty rapid track back to surplus, and I think even in the election campaign, it has been people have underestimated just the challenge in getting back to surplus as rapidly as we're saying. We're talking about the deficit halving this year, halving the next year, and pretty much disappearing the year after that.
But even then, and I know you disagree on the issue of the structural deficit, we've embedded this spending into the economy, government spending into the economy, particularly around working for families, interest-free student loans, which really we can't afford, can we? And as we borrow to fund that, we push up the currency and make ourselves less competitive.
There's some, like yourself, Bernard, who've always argued that we should go faster on this process and have a bigger hack at those programs. We've made adjustments to them, including KiwiSaver, which we think means they're manageable. But there is going to be the days of new cash transfers from government to families and households are over. There won't be any new cash transfers, and we will need to succeed in getting reasonable growth rates for people to maintain those programs.
What happens though if we don't get the economic growth over the next couple of years? If the Christchurch rebuild is slower than expected and the global economic outlook deteriorates, and Treasury forecast at least a 1 in 5 chance of that, and of a meltdown of a 1 in 20 chance, and that was before some of these shenanigans in Greece and Italy. What's your plan? What's your plan B if we don't get that economic growth? Because you're really betting everything on that economic growth to get you back into surplus.
Well, it's not just betting on economic growth. I mean, we've been taking a number of measures to deal with the risks that we have to manage. So getting back to surplus is really important. Secondly, is getting the banks in good shape through the regulatory powers of the Reserve Bank, because we can see around the world countries with failing banking systems really take a hit. And thirdly, diversifying the income streams somewhat. So the push on free trade has meant that we've actually seen, just in the last 3 or 4 years, quite a rapid shift in the sources of our income to the faster growing economies with better prospects. And that has actually been a pretty key element of the moderate growth that we've got and the reasonable growth that we're forecasting. So we're not quite as exposed to those risks as we used to be.
On that issue of the banks, the Reserve Bank is pushing through its open bank resolution policy. As the Minister of Finance, someone who'd have to make a decision about supporting a bank if we ever got into trouble again, would we really let a bank fail?
Well, the open bank resolution policy is designed to maintain a bank, but ensure that it's the owners and bondholders who take the haircut rather than the taxpayer. And I think that's quite important.
What about term depositors, though?
Well, that's all part of the document about whether there would be any part of the discussion about whether there would be any haircut on depositors. But I think the general principle here is quite important. We are much better to have a banking system that's strong to start with, but then knows it faces the consequences of the risks that it takes. And by the middle of next year, we'll be actually unique in the developed world and having no formal guarantees in place. And by then, we'll have the open bank resolution policy in place, which reduces the prospect that taxpayers would be underwriting risks taken by bankers. And I have to say that's a pretty unpopular policy around the world.
One of the things the banks are saying is that because we don't have that implied government guarantee anymore, and because of higher funding costs, we might actually put up mortgage rates, even though the Reserve Bank doesn't put up interest rates. Or if the Reserve Bank does put it up, we'll put it up by even more. What would you say to the banks if they did that?
Well, their interest margins are looking pretty healthy right now. I think there's a bit of slack there.
Now, looking at the savings issue, one of the key areas of debate in this election campaign, why won't you increase the retirement age to 67?
Well, the government's took a position back in 2008, made it very clear that it thought stability around superannuation policy was really important, particularly to older New Zealanders after a 20, 30-year argument over how it should be structured. So we factored into our forecasts an age of 65.
But we can't afford it. Even your Retirement Commission and the Treasury is saying that.
Well, it's all there in the forecasts, so we're not going to change the position. I mean, that's been pretty clear cut, and we've been focusing on the next biggest future liability, which is your long-term welfare dependency. Because the more we can make progress there, the better the growth in the economy, the more likely it is that people will have a reasonable retirement.
What do you say to the young people who come back to you and say, well, do you really care about what's happening after 2025 and whether I'll have to pay higher taxes or have big debts to pay for all these baby boomers who are retiring and getting sick?
Well, we certainly do care about that, and that is why they need to be very wary of politicians who promise them free stuff, because they're going to have to pay it all back, and why we need to make sure that they've got an economy where they can lift their income sufficient to meet even their shorter term requirements of a decent income, being able to buy a house, being able to save a bit of money.
The IMF and others have said one of the problems in the global financial crisis is a widening of inequality between the very rich and the poor. And New Zealand's Gini coefficient, which measures how wide that gap is one of the fastest growing in the OECD. And that was before the tax cuts introduced last year, where those on highest incomes got the highest benefits. Are you worried that a widening of inequality makes New Zealand more vulnerable and repeats some of these mistakes seen overseas?
Well, I don't agree that there's a significant widening of inequality. The tax package we put together, we published the analysis, including the Gini coefficient, of the impact of the full package. And more recent work the Treasury's been doing around fiscal incidence shows that the decile 10 households are really the one decile that has in recent years taken a reduction in income. And that's, I think, most likely because interest rates have dropped quite considerably. That's the income group that has money in the bank or is in the bond market or whatever, and rates coming down. So I don't think it's open and shut. I mean, the real about growing inequality, the real challenge is getting the opportunity and the mobility in the bottom end of the income range. So if people are on a benefit, of course it's there to support them for a while, but if they're stuck there for 10 years, that's the worst of inequality, and we've got to do more to get them out of that trap.
What do you say to the Occupy Wall Street movement? And there are some people in New Zealand who are protesting here about this widening gap in the equality of countries, rising youth unemployment. What do you say to them? How do you feel about what they're protesting about?
Well, look, where we agree with them was their concern about the way that middle income people are seen to have to carry the burden of wreckage in the financial markets, and that's why we, more than almost any other country actually, are moving away from that, reducing that possibility. With respect to inequality, I'd say the same. I'd say what I said before. I mean, the thing here is about getting mobility at the bottom end. New Zealand's actually handled this reasonably well through the recession, and we have the opportunity in a growing economy to get that mobility working more at the bottom end.
But if the economy doesn't grow, because that's what a lot of the Occupy movements are saying, that maybe we're entering into a period of very low, slow, no growth, sort of a Japanese-style recession. What's your plan then? Because at the moment that would imply blowouts and deficits, rising debt, and eventually the same fate as someone like Greece or Italy.
Well, I get the sense a lot of them would prefer no economic growth. But you're right, if there's no economic growth, that is has the worst impact on inequality, because people don't have the opportunity to move out of the bottom end.
Your plan B, though? I get a sense neither the government or the opposition have a plan B if we see some sort of meltdown in Europe. And voters have no idea which way either side would go if there was that.
Well, as I said before, I mean, we've been taking steps to reduce the risks. Of course, there can be major events like the Lehman's crash back in 2008. New Zealand managed its way through that. We could manage our way through some extreme event again, but we think the risks of some extreme event in Europe hitting us hard are a bit less than they were because of the steps that have been taken.
And finally, ownership of our own assets and borrowing that we do. Some people look at what's happened over the last 20 years and can see a rise in the share of income that has to be sent offshore in interest payments, on debt and on dividends on foreign-owned assets. One of the complaints people have is that New Zealand has progressively borrowed and sold assets simply to continue spending more than it earns. Isn't your government borrowing a lot and now plans to sell assets, simply continuing on that trend of spending more than we earn?
No. We would rather pay dividends to New Zealanders than interest to foreigners. And people seem to be remarkably keen to borrow more money off these markets where debt is so toxic.
You just borrowed $20 billion last year.
That's right, and of course that's the peak, and it has to come back, no doubt about that. And one of a number of benefits of the asset sales is it gives us the opportunity to retain control of those assets at 51%, but get cash in for infrastructure investment that we don't have to borrow off someone else. And this is in the context of a balance sheet that is now close to 250 billion, and that the government, that taxpayers own. It's going to grow by 20 to 30 billion over the next 4 or 5 years. So in 4 or 5 years' time, we'll own another 25 billion worth of assets, and we're talking about 5 to 7 billion. And we're just doing what any household or business would do, and that is with a big mortgage and a growing overdraft, we've got to get the overdraft down, and we've got to reduce that rise in the mortgage.
But wouldn't we be better off simply reducing our spending and reducing the need for the borrowing and the need to sell the assets?
Well, we're going to be doing both, and I don't think anyone should underestimate the challenge of reducing the proportion of government spending on GDP. I mean, over the next 4 or 5 years, it's going to drop from 35% of GDP to 30 or 31. Which is a pretty rapid drop, even on moderate economic growth. So there's we have to do both. That's the situation we're in. Get some cash in that we don't have to borrow, which will also help with our capital markets. It'll give New Zealanders something to invest in apart from finance companies that might be a bit better than those. And we also need to reduce our spending. So we're into a significant adjustment period now, and I think the public understand that pretty well, and they want to see continuation of some sensible and balanced government to implement that.
Bill English, Finance Minister, thank you very much. That was another in our series of double shot interviews. I'm Bernard Hickey for interest.co.nz.